Hey everyone, this is Kirk here again at optionalpha.com, where we show you guys how to make smarter trades. And today we're going to go over all of the trades that we made both Thursday and Friday this week and kind of round out some of the trades that we had for expiration. So right inside the membership area, you can see the new trading alert page that we have that we're linking to in this video. And we had a couple opening trades and one opening trade on Thursday that I wanted to go over, and then everything else is pretty much from Friday. So the first one that we're going to go over is an EWW trade, and since we only had one trade on Thursday, I just wanted to cover this one real quick as part of Friday's video instead of making two different videos for it. So in EWW, we basically just saw an opportunity to add some more premium as the market, is starting to rally, and a lot of things are rallying, but we wanted to go ahead and add some negative deltas to our portfolio, meaning that we want to go bearish on EWW. I think kind of the recent bounce has been okay in Mexico, but I don't think that it's going to last too much longer, and so we just saw an opportunity to possibly sell some premium. We went ahead and did the January 62.64 call spread for about 30 cents in credit. So that puts our break-even price around 62.30 for EWW in January. So here's a look at the chart here, and you can see that implied volatility really has spiked up in this ETF. And so with our break-even price, it allowed us to move our strikes up to about 62.30 for EWW. So really good pricing on this trade. Also gives us a lot of room for Mexico and this particular ETF to continue to rally, and we could still make money, right? Because EWW can rally even higher to 62 and we still make money, or it could stay flat, or it could obviously go lower. But all we're really looking for is that drop in implied volatility, which we started to get already. But if we can continue to see a drop in implied volatility, that would really, really help kind of solidify this position. As far as pricing goes, here are the January options that we have. And you can see that we started at about the 18% probability level. So that first strike that we sold, there's about an 18.85% chance that EWW goes from where it's at now and closes above 62 by expiration. So basically what this means is that we've got about an 80% chance of winning on this trade and about a 20% chance of losing. So we still kept it small as always, but this is, a classic example of a high probability credit spread trade. All right, so the other trades we went over, or we're going to go over today, we did get into more of IWM. So we had a nice month trading IWM last month and did our custom trade in IWM, that custom naked position. And what we want to do this month is go ahead and just add some more premium. This time we did it all the way out to February. We did the 108-106 put spread for 25 cents. So again, trying to be kind of non-directional in all areas. We've added a QQQ call spread before, and so we wanted to add IWM because if the market does continue to rally, we want some positions that are going to make money with that market rally. So we did the 108-106 credit put spread in IWM for February. So as we look at the trade tab here of IWM, you can see, again, we try to be very high probability about how we're making this trade in February, and we decided to go ahead and do, like I said, the 108-106 put spread below the market. So again, at that 15% probability level for that 106 strike being hit. So what that means is that the likelihood that IWM goes down and closes below 108 is about 15%. So we've got a trade here that's about an 85% chance of success. It's obviously a little bit of a credit, so you don't get a lot as far as a credit is concerned. You only get about $25 for the one spread. But again, this is what high probability trading is about taking in small credits and making the odds work in your favor long term. We also did an Iron Condor in AMZN, which is Amazon. I really like this trade because I think the pricing was pretty good in Amazon, and it kind of popped up on our radar to have high implied volatility. We went ahead and did the January options because they're very liquid. Didn't need to go out to February. We did the 325-330 call spread. So again, selling the 325, buying the 330 on the call side, and then the 265-260 put spread. So we sold the 265 and bought the lower strike 260 put spread to take in a credit on Amazon. So because the width of the strikes on those is $5, we're basically putting up about $400 of capital to risk about $100 of capital for the Amazon trade. And let me just bring up the Amazon chart as well so you guys can see this. All right, so here's the chart of Amazon. You can see that, the stock has had a really tough time as we headed towards December expiration, but I think, we kind of settled into a little bit of a range here, and implied volatility has already started to drop, but it was above that 50th percentile when we actually entered this trade. Now, with our strikes that we selected, we kind of went neutral around where Amazon is trading right now, so we are not taking too much of a directional bet either way. We're trying to be fairly neutral in our direction. And you can see on the top side of the trade, so we'll look at the top side here, the probability that Amazon gets to our top strike at 325 is about 20%. And because they've shifted today with the market open, the probability that Amazon gets down to our bottom strike all the way down here at 265 is about 7%. So those were even at about 15%, but we've already had a move up in Amazon over the last day. So that's obviously, kind of affected the position. And what we can do here, if we get a continued move higher in Amazon, is take this put spread and roll this put spread closer to the market. So we talk about that inside the platform here in the video tutorial section for trade alerts, talk about the mechanics of actually rolling that spread closer. But that's something that we can do for sure if we start to get tested on Amazon, but I still really, really like this trade going forward. Okay, so a couple of trades just that actually expired today. ANF, which was a really good trade, a trade that we've held all the way since earnings in Abercrombie & Fitch. All 5 of our iron condors in ANF have expired, so we took in a nice $115 profit on that trade. GLD, we're going to be doing a pretty big case study on GLD. We had 3 iron condors, and I didn't put up any of the strikes because this was an iron condor that we've kind of legged into a couple times, and so we had so many different strikes, but it was a trade that we made adjustments to and actually increased our potential profit in this trade by adding those adjustments. So over the individual or the original position that we had, by adding those adjustments to the position, we actually increased the profit in the trade. So it's going to be an interesting case study, and we'll be posting that inside the platform. And then FXE, all of our iron condors and FXE that were left expired, worthless at the end of the month too. So after all adjustments that we made in FXE, because FXE did actually go against us, again, this is another one that we'll be doing a pretty interesting case study on. Take a look at a stock that goes against us just outside of the range that we needed, but after we made adjustments, we were able to take a nice $56 profit. So it wasn't a huge winner, but it could have been a loser had we done nothing on the trade. So really, really good example of how we were managing the winners there. All right, as always, I hope you guys enjoy these videos, and if you have any comments or questions, please add them right below in the membership section. And until next time, happy trading.